Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. High prices force a special meeting of the RBI panel on interest rates. The Monetary Policy Committee will meet on 3rd November, likely to discuss a reply to the government on why the RBI has been unable to contain inflation. Sensex and Nifty end a volatile session in the green as bulls gain momentum. Nifty ends the October series on a positive note, gains over 900 points. US escapes the clutches of recession post the GDP growth of 2.6% in July to September after 3 back-to-back contractions. Elon Musk enters Twitter headquarters carrying a sink, assures employees of the social media platform there will be no layoffs. He has just one more day to complete the buyout. A bland Auto Expo 2023, especially for bike lovers. All major two-wheeler companies to skip the Auto Fest. Luxury car makers also stay away from the event happening after 3 years. The Reserve Bank of India's Monetary Policy Committee is holding a special meeting on the 3rd of November. It's expected that the panel will discuss a response to the government on why its actions have been unable to rein in inflation. For more on the significance of this meeting, we have with us Managing Editor of the Business Today magazine, Anand Adhikari. Anand, thanks for joining us. Take us through really what's at stake here for the RBI. How significant or how difficult really is this task going to be, given the kind of conflicting factors they've been dealing with in order to rein in inflation?
Thank you, Abha. So, as per the mandate, Abha, the RBI response will be on the 3 major count. One is the reason for missing the target for 3 consecutive quarters. Second will be the action plan, and third will be the timeline for getting back to below 6% and around 4%, which is the target. Now, if you see the reasons for missing the target, the Russia-Ukraine conflict changed everything. If you see post February, inflation started moving up, and that was one of the reasons which came out of the blue for RBI. And second, if you see the global interest rate, again, because of high inflation, US, UK, all global economies, they started hiking interest rate. And that led to depreciation in the Indian currency. And inflation came via the currency route because we import oil and other food grains. So these are 2 main reasons, for missing the target. And I'm sure RBI will mention these 2 factors prominently. Second, if you see the action plan, and that is twofold. One is the liquidity and second is the repo rate. And today, if I see the liquidity in the system, the average daily liquidity is around 2 to 3 lakh crore, and RBI has to reduce that liquidity to contain inflation. And second is the repo rate. I mean, they have already increased repo rate by 190 basis point in the last 5-6 months. And I'm sure in the coming December policy, we'll see further hike, maybe 35 to 50 basis point. And third and final, is the timeline. If I see RBI's own projection, is 6.7% for CPI for the entire 2023, which is much higher than the 6% upper tolerance limit. But RBI expects the interest rate to come down to 5.8% by December quarter. So, October to December quarter 2023, they expect it to come below 6%, which is good news. And finally, in the first quarter of next year, that is 23-24, they expect the inflation to be below 5%. I'm sure RBI will mention these projections, when they respond to the government.
Sure. What are the risks at this point, Anand, as you see them? Because, on one hand, we have the US finally showing some growth this past quarter. On the other hand, the situation in Europe only seems to be getting worse. So while things seem to be looking a little bit more cheerful for the Fed, back home, what do you think are going to be some of the resulting implications? Where does this place the RBI when it comes to being affected perhaps by also some of those global dynamics and how they could also lead to inflation further being an issue?
So the biggest, factor is the geopolitical risk. If I see, on the one hand, we have global recession, which will impact the, the export and the, other things. Yeah. But again, on the inflation side, if you see, US and UK, they are facing historically high inflation. It's like a 40-year high of over 8%, and their target is 2%. Now, to bring down the inflation from 8% to 2% will take some time, and we'll see further hikes in the global interest rate, and that will strengthen the dollar and maybe weaken the rupee. So we have the biggest threat of this imported inflation, which will come via the currency route. And even the RBI, if you see, the the forex reserves, I mean, they had 640 billion, a year back, and now we have some 540 billion, almost 100, billion US dollars shaved off. So they have limitation to different rupee, So I see the biggest risk which I see is the global geopolitical factor.
All right, Anand, thanks so much for joining us with that. Clearly, everyone's still keeping an eye on how things progress on the global front. Indian share markets today ended higher as strong rollovers were seen in sectors such as infrastructure, metals and banks. Gains in global equities also underpinned Indian shares on a day that marked the expiry of the October derivative series. The Nifty 50 closed 81 points higher at 17,737. The Sensex was up over 200 points. JSW Steel was the biggest gainer in the Nifty, up 5.5%. Other top gainers: Hindalco, Tata Steel, Adani Ports and Power Grid. Bajaj Finance, Bajaj Finserv, Asian Paints, Bajaj Auto and Tech Mahindra were some of the biggest losers in trade today. Housing sales are likely to hit an all-time high this year. According to a study by property consultant Anurag, sales could hit 3.6 lakh units in 7 major cities on the back of strong demand, despite hardening of interest rates on home loans as well as increasing property prices. Abhishek Basumalik joining us now from Intelsense Capital. Abhishek, what are you making of the realty sector on the back of the Anurag report? How positive are things looking in terms of rising demand and that interest and demand staying intact for the sector across some of the major metros?
What is happening is multiple factors are playing out together. One is that post-pandemic, I think everyone realized that there is a need for a good living space, whether so somebody who stays in a 2-room apartment is probably looking to upgrade to a 3-room one, and so on and so forth. So that is one part. The second is a lot of people were renting out, staying in rented accommodations. Some of them are moving or thinking about moving into a property that they own. So these are not something that happened or that is happening suddenly. I think this is an event which was triggered by COVID, because you suddenly got into that phase of of need. So that is one side. The other side is we saw low interest rates, which also helped people make that decision. And I think another factor is that if you see what is happening is, again, during these last 2.5 years, the income distribution between the people at the top half of the curve, if I may put it that, has not been affected at all. So the rich or the upper middle class has not been really affected, and their expenses have was reduced to an extent because they were sort of staying at home and not too many avenues to spend. So savings was there, and this is in contrast to what has happened at the lower end of the segment, where we are seeing certain amount of stress. If you look at two-wheeler sales, etc., you're seeing some amount of stress at the bottom half of the segment. But at the top half, where even in the real estate, you will find that more expensive properties are selling out faster.
Yes.
Right. So that is what is happening. So that is the trend overall in the country. Now, real estate is another interesting sector, which is very, very location specific. So a Bombay or a Mumbai market will be different from a Bangalore market, will be different from a Chennai market, will be different from a Calcutta market. So all of these markets behave differently. Even in large cities like Mumbai, micro markets will behave differently, right? So you can't take a real call saying that, okay, I will, you can't take a broad brush call saying that all real estate will do well, because in India, real estate companies have different styles or different geographic concentrations. Some are only residential, some are commercial, some are a combination of the two. So all of these, are mixed together.
Sure. Now, despite the boost in sales, stock performance for the sector has been rather bleak. A few of the realty stocks have underperformed even in the last 1 year. Is there a buying opportunity there?
So, you have to be very clear as to what kind of time frame you're looking at. So one, if you just ignore the stock price performance for a moment, one of the reasons why, even let's say the revenues or the profitability for companies have not come through all that much has been because in the last 1 year, we've seen a huge escalation in input prices. Cement prices have gone up, steel prices had gone up, stone chip prices have gone up, sand prices had gone up. Now we are seeing a moderation in all of these. So obviously, once you start looking 3 months, 6 months down the line, all of this, the numbers will start looking slightly better. So that's one part. Second is, from booking to delivering to the end customer, it takes roughly between 12 months to 18 months for a, so as for an apartment, for example, to be completed and handed over. So you'll have to give it that much of time. Say last year the sector actually started picking up. So you'll have to give it a year's time for it to actually fructify in the numbers coming out. Now, in terms of stocks, if you look at, say, a Shobha or a DLF in the larger cap space, they look quite good to me. In the smaller space, I think maybe an Anand Raj was looking quite interesting. Kolte Patil looks interesting. So, different plays across the space are available.
All right, Abhishek, thanks so much for joining us and taking us through all the latest in the realty sector. Elon Musk all set to close the Twitter deal by tomorrow. His co-investors in the $44 billion buyout will include Sequoia Capital, Binance and others who've been formally informed of his intentions. Friday also marks the deadline set by a court in the US.
Elon Musk at his bizarre best, entering Twitter headquarters carrying a bathroom sink. His weird action explained in part in this tweet. Entering Twitter HQ, let that sink in. But it was the status on his Twitter handle which explained a lot to the public. If letters to financiers informed them of his intention to complete the Twitter deal, it was this status as the chief twit which announced his intentions to the world. Twitter shares have risen more than 7% this week, jumping to close near the $54.20 offered by Elon Musk this April. The company's share price has been seesawing since April when the deal was announced. The highs and lows set by Elon Musk's statements and mood. Trading the stock has been suspended by New York Stock Exchange on Thursday. The stock was at $39.31 on the 1st of April and shot up to $51 in just 2 trading days. However, Musk's refusal to go ahead with the deal saw the stock plunge to new lows in the second week of July. Now, with the deal just a day away from signing, the stock is up again. The deal is backed by some of the biggest banks and global investors. Morgan Stanley and Bank of America have committed $13 billion in debt. Investors, including Oracle co-founder Larry Ellison and Saudi Prince Al-Walid bin Talal, are pitching in with $7.1 billion. There are, however, doubts over the future of Twitter's Indian origin CEO Parag Agrawal, who has frequently been in Musk's firing line. Agrawal has also not shied away from taking pot shots at Musk in the past 6 months. The cyber world, meanwhile, has exploded with memes. This meme video shows an Elon Musk lookalike on a firing spree with a paintball gun, fulfilling his promise of firing 3/4 of Twitter staff. In reality, he calmed some of the frayed nerves on Wednesday, saying he had no plans to do so. Bureau Report, Business Today TV.
Credit Suisse shares plunged more than 14% in trade today after the financial major announced a loss of more than $4 billion in the July to September quarter. Analysts were expecting a loss of an eighth of that value. Nearly $3.6 billion have been written off for deferred tax assets. Under the plan, Credit Suisse will spin off its loss-making investment banking business into an independent unit. The bank is also shedding 2,700 jobs, or 5% of its workforce, by the end of this year, and will raise up to $4 billion in capital by selling stock. Meta shares plunged as much as 18% on Wednesday after the company painted a bleak picture of the future in its quarterly results. The results knocked off about $40 billion of its value, making founder Mark Zuckerberg poorer by $2.7 billion. The results comprised a slew of problem areas for investors. Overall, the stock has fallen 62% this year. The tech major offered a weak forecast for the upcoming quarter. The company is unable to make money off of its latest ventures, where it's pumped in billions of dollars. Reality Labs, its metaverse company, saw $3.7 billion in losses in the quarter. The company expects these losses to grow significantly next year as well. Even Reels, the video content product to rival TikTok, is struggling to monetize on its views. Zuckerberg has, however, defended the heavy investments as important for the future of Meta. He said people will look back on this decades from now and talk about the importance of the work that was done here. To explain what difficulties Meta and Facebook are going through, we have with us our tech editor Ayush Alavadi. Ayush, what's gone wrong with the Facebook dream, the Facebook model?
Revenue declined for 2 straight quarters for the first time in the company's history, and a revenue drop expected in the ongoing quarter as well. It looks like all is not well in the Meta world, clearly. Remember, all of this comes on the backdrop of a bunch of things: weak global economic growth, competition from the TikToks and the BeReals of the world. BeReal seems to be an app a lot of youngsters are using nowadays. Netflix and Disney for advertisers. Concerns, of course, around profitability and return on investment. What is the metaverse, this abstract concept that Mark Zuckerberg's been talking about? Of course, there's also the threat of regulation in different countries around the world, even in markets like India. It seems like when you speak to people in the tech world, people aren't entirely sure about this meta dream that everyone's talking about. Mark Zuckerberg has a certain interpretation or a vision of the metaverse, and clearly, judging by these results, all is not well.
Ayush, do you think the steps the company has announced will work out?
Well, that's an interesting question, because in terms of reviving the company, Mark Zuckerberg's bet seems to be the metaverse. And if that's his interpretation of the metaverse, for now we've seen no real proof of concept. And while there is potential in this whole Web3 world about what the metaverse will be all about, we don't know if the metaverse will take off in a big way, apart from maybe gaming perhaps. And then when you're talking about gaming, there's a bunch of competitors who are already investing, like the Microsoft Activision deal, $69 billion, so much potential to do things in the Web3 world or the metaverse world. But all of this is Web3 conversation, or conversations of the future. In his Web2 businesses, they aren't necessarily innovating. If you have a look at them, Facebook is used lesser and lesser by teens. A lot of people have flocked away to TikTok, BeReal. Snapchat's always been a lot more popular. Facebook, of course, is used lesser. Then if you talk about any new feature that maybe Snapchat or TikTok launches, Facebook and Instagram seem to copy it almost in a matter of days, if not weeks. Reels is something that the company has taken a very serious stance on. They want to monetize it and make it a revenue driver. But even in terms of Reels, there's a lot of competition from other short video apps. Here in India, there's a bunch of indigenous apps which came with the TikTok ban. And in the rest of the world, TikTok seems to be quite popular, if not more popular than Instagram's Reels product.
If you're hoping to see your dream cars at the next year's Auto Expo, you'd better temper your expectations. The COVID pandemic may be over, but all's not well with the sector just as yet. Some of the biggest auto companies have opted to stay away from the biennial event. Auto Expo was to have taken place this year, but had to be postponed a year because of COVID, of course. The two-wheeler section will be much diluted, with all the major players like Honda, Hero MotoCorp, TVS, Bajaj, Royal Enfield, even Harley giving the Expo a miss. Among personal vehicle manufacturers, the entire German pack comprising Mercedes, BMW, Volkswagen, Audi and Skoda are skipping the meet. Even Mahindra & Mahindra has decided to stay away this time. The focus is likely to be on electric vehicles. The other manufacturers comprising Maruti, Hyundai, Tata, Toyota, Kia are likely to be present in a large number. For more on this, let's go across to Business Today TV's Chetan Bhutani. Chetan, why so much of a gap in the, those displaying at the Auto Expo? I mean, perhaps some of the global giants, it could be post-pandemic lack of supplies or wanting to spend on exhibiting here. What is it? Is that it? And why are some of the domestic majors staying away?
Well, Ava, you're absolutely right when you mention all of these reasons behind it. Auto Expo, which is now really happening after 3 years in January 2023, is likely to miss the usual glitz and glamour, with top two-wheeler companies are likely to give it a miss. You mentioned the names. However, the traditional passenger vehicle manufacturers like Maruti, in fact, who are leaders in its own segment, like Maruti, Tata Motors, Hyundai, Kia, MG Motors, Toyota Kirloskar are likely to participate in the Auto Expo. In fact, in the commercial vehicle space, JBM, Tata, Eicher, Ashok Leyland, SML Suzuki are quite the big names who are likely to participate in the Auto Expo January 2023. However, the names that you mentioned, like two-wheeler companies, which comprise literally 99% of the two-wheeler space, including Hero, Honda, motorcycles, TVS, Bajaj, Royal Enfield, are likely to give it a miss. In fact, Mahindra, Volkswagen, Renault are also planning to give it a miss. In fact, when I spoke to my sources in Siam, I was told that the our companies are in touch with Siam, and they're likely to be persuaded more so that some more names can become on board. However, Business Today TV has also learned that high logistic costs, location issues are some basic issues that the companies are facing. In fact, you also pointed out that the highlight will also not just be ICE vehicles this time. It would be the electric vehicles, with the majority of electric vehicle companies participating to showcase their products in the Auto Expo 2023.
All right, Chetan. Great chatting with you on what to expect from the Expo this year. Now let's take a look at what else is making news in the corporate world. EdTech major Byju's in trouble again. The Kerala regulator has ordered a probe into the company's shuttering its Technopark office in Thiruvananthapuram. More than 170 employees are working at the office, and all of them have been let go. Medanta Hospital is going public. The IPO of its parent company Global Health Limited will open on the 3rd of November and close on the 7th. The share sale consists of a fresh issue of 500 crore rupees and an offer for sale of up to 5.08 crore shares by the company's shareholders and promoters. Kaveri Seeds has approved a 1.3 billion rupee share buyback at a maximum price of 700 rupees per share. At this, the company will buy back 1.79 million shares. The stock was up 6% in trade today. While tech hiring around the world enters a big freeze, the battle for top talent has gotten fiercer. Our tech editor Ayush Elawadi caught up with the Chief Technology Officer of Siemens, Peter Kurte, in Berlin. Here's what he had to say on the current issue.
Look, Siemens is viewed as this historic company that's done some really cool things in the past. But now you're competing with the likes, to some extent, of the Googles and the Apples of the world. So then you need top talent coming in.
We do.
When you need that top talent coming in, how do you ensure the cool quotient for Siemens now? As CTO, I'm guessing your role becomes even more vital.
Yes, you're right. So it is really all about people. And the good news about Siemens is we always have been, from the very get-go, we have two things in our DNA. We love technology, and the tougher the problems, of course, that we can solve through technology, the better. And we really take care of our people. And you can tell us, because the people that join Siemens, of course, they stay for a long, long time.
Yes.
And we have many generations, actually, that stayed over and over. Now, to your point, though, is what we have to do a better job is to be out there, be heard of, and really show of what we're doing. I think we can do better, and we have to do better. So this is why also, when I was in India just a few weeks back, we also went to the Indian Institute of Science and, you know, tried to share the great things that we're doing. Because here's the thing, it's a different thing if you try to program an algorithm in order to consume more social media, which is nice, or if you really try to enable, you know, for example, the energy transition. That's right. Because we know that this planet actually is heating up too quickly, and we can make a huge, meaningful difference.
Interesting, and you know, I think it's fascinating, talking more about your profile. As CTO at Siemens, you got to really understand the confluence of hardware and software. When you're talking about the industrial metaverse, I think that's what people need to understand, that the metaverse is not just putting on these AR, VR glasses. and then maybe going for a workout or something like that. It has tremendous potential when we want to really shape the digital transformation journey.
Exactly. Because, again, the concept of taking the digital twin to the metaverse means that we get real-life data from the factory or from the building or whatever fed back into it. So therefore, you always have to have sensors in the real world that sends the data back. And this is precisely what we do at Siemens.
Peter, some fascinating insights over here as always. Always a pleasure to meet you. And I said this the last time, you know, maybe I should be saying danke to you this time in the metaverse.
Yes.
Good seeing you as always.
Thank you so much. Thank you.
And that's where we leave it on the show today. Thanks so much for watching.